Hello, great minds. It's been another beautiful episode again in which 30 days of bootcamp. My name is Joseph Samuel, your instructor, your friends, and your coach. Um, that reminds me, we are having low subscribers. You're just watching these videos and you have not subscribed. Please click on the subscribe button and get the notification bell turned on so that when we come back again, you can definitely catch up with us. Okay, so over the period of time, we'll be learning various things. We've learned different peers. Oh, sorry, you've learned on what is forex market. You have learned on different terms in the forex market, and today we are going to be covering something different. Something different. But before we proceed, let us quickly talk about types of market peers. Market peers, because you know that we've said that the forex market is open 24 hours a day, right? And it's actually divided into four different sections. We've talked about the Sydney section, the New York section, the Tokyo section, and the London sections, right? But as those markets those sessions are, they are in different peers. They are in different peers. So we're going to talk about what's called market peers. Market peers, and we have three major market peers. We have the major peers, we have the minor peers, and we have the exotic peers. So just take your pen and just write them down. I will show us on the chart here. We have the minor peer, the major peer, and the exotic peers. Right? We'll talk about minor peers. Okay, let's start with major peers. We're talking about peers that are with the USD. Basically, your Euro USD, your GBP USD, your USD Okay, if we check on this watch list here, these are major peer. GBP USD is a major peer. Euro USD is a major peer. Okay, ZAR USD, they are major peers. Okay, now they have one of the things is that the advantage they have is fact that they have low spread and high liquidity. What do you mean low spread? Spread, we talk about for that spread is this difference between your ask price and your bid price. Okay, of course, that is what determines the profit of the sometimes determine the profit of your broker. Okay, and then liquidity has to do with the amount of money. That means the lot of money that is being moved um into that pair on a regular basis. So they have high liquidity and low spread, and that is they are very best for they are best for beginners. Okay, so we have what's called the minor pairs. The minor pairs, they don't include USD. So something like Euro GPP, Euro JPY, like GPP JPY, these are minor pairs. They have more volatility and moderate spread. They have more volatility and more, meaning I'm just bad that they move faster. They have more speed compared to the major peers. Okay, then we have what is called the exotic peers. The exotic peers has to do with one major currency plus one from a developing or smaller economy. Example is USD try has to do with Turkish what is it called, USD try, that's Turkish lira, right? We have USD ZAR, USD ZAR. So this USD ZAR, that's South African rand. Then we have Euro NGN. Euro NGN, that's your naira. You wonder, did they even trade naira? All right. Euro NGN is also another one. That's the Nigerian naira. Okay, that's the chart of the Nigerian naira. So one of the things is that they are very volatile and they have widespread. So you don't want to joke with them. You don't want to near them at all. For beginners, don't even go there. They are none of your business. Okay? Don't touch them. Don't touch them. They are fire. All right. So now let's get back to business of the day. We're going to be talking about more terms in the forex market. We've mentioned bullish before, but now I want to actually break it down a bit more at this point so you can just understand what that means. So excuse me. Okay, so I want to talk about bullish market because these are basic concepts um you must take with high priority. Bullish market. Okay, I'll talk about bullish. Bullish has to do with something that is going up. Okay, that's you are buying. You are buying. You are buying. Bullish has to do with buy. All right. So when we say a market is bullish, it means price is going up. The buyers are actually in control. They're in control. They're in control of the market. Buyers are in control of the market. The market is bullish. That means what I want to do at that point is I want to buy the market. I want to buy the market. And when we say that market is bullish, we mean that market is forming. Where's my part two? Market is creating something like this. This is a high, a low, a high, a higher low, a higher high, a higher low, a higher high. We'll get more updates on all of this as we proceed, but just pay attention to this, right? So this is a high, and this is a low. Begin from a low. Market came. This is a high. Market came down here, shoot up and break this high. Okay, break this high. Break this high. Came down again. Now it did not come down and break this low. Rather, it reached a certain level and decided to go up again. That is another break here. And it does this again, come down again, and come again and break again. Once market keep doing like this, what you are looking for in the market is you want to buy the market. That is bullish. And when you are buying the market, even that we'll still repeat it several times again, you don't just jump and buy market. No, we've talked about pending order and limit orders, right? You don't just jump and buy market like here. You want to wait for market to come down a bit. It's what we call retracement. Okay, you want to wait for market to retrace. Wait for market to retrace down like this. Come here because you don't want to buy price at high. Our price at this place is very high for you. You don't want to buy market here. You want to wait for market to come down here and then you want to buy. Okay, so that is that. So a very quick one. Once you now see that market now did something different, possible is instead of coming like this, it and going up again, it actually did something like this. At this point, you begin to change your perspective. We'll be repeating this one over and over again. You begin to change your perspective. Like, okay, now I begin to think otherwise. Okay, this market seems like it is not going up again. But if it now still do like this, you can still take that one and still do like this. Okay, and still go up. But until you do it and do the second one like this, and fail to break this low, and you see that it's doing forming candle going up again like this, then you will know that okay, it still wants to continue upward. But peradventure it does like this and did like this and fails to break this high and just created like this and come like this and did something like this, you know that this market is not going up again. What is the market doing now? It is selling, and that will lead us to the second term, which is called bearish. Bearish. Now, bearish has to do with the fact that the market is coming in a downtrend. So when somebody said the market is bearish, it means that market is going down. The sellers are in control. Remember, in bullish, the buyers are in control, but in bearish, the sellers are in control. So market in selling, we've talked that in bullish, the market is actually creating what? A high, a lower, a low, a higher high, a higher low, a higher high, and a higher low. Why we call it higher low is because this is a low, this is a low, but this low here is actually higher than this low. It goes up. You can see that the distance, just like you are climbing a ladder, right? The distance here to here is actually progressing. It's actually progressing higher, progressing higher. So we call it higher low. Yes, they are still low, but we call them higher low. Okay. Test writes, most people will just call it HL. Let me just write it. You have HL. Okay. Why this one becomes HH. Okay, higher high, right? So let me just write it here. So repetitively you can fill up. I don't want this video to be too long for us. Repetitively you can fill up those spaces. So you can see that this one will, sorry. So this one can fill up repetitively like this, higher low. You can fill up higher lows, right? You can fill up higher lows, right? While this one can be what? Higher high repetitively. Oh, sorry. So this can be higher high repetitively, higher high repetitively. Are you getting that? So that is shows that the market is what? Is going up, is still going up, and that is what you want to be seeing. That's for bullish market. Now for bearish market, what you see that the market is forming this trend of down movement, like it's coming down. It's just forming. This is a high, breaking lows, breaking lows. It keep breaking lows. It keep breaking lows. I want to see that it keep breaking lows. We don't want to see it breaking this high. Okay, we don't see it breaking this high. Even though it can break this high once and come again and break this high, this low rather, and come again and break this low, right? That we want to see repetitively, right? And we cannot label it. Now it's not difficult to label too. The same way we started this one as a what? A low, right? So I can start this one by calling this one what? A high, right? So let's start. It's very, so that you don't just cram. It's what you just need to take one step at a time. So this is a high. I call it H, right? We began with that. These are H. And note that again that, okay, this one is, then we have a low, right? This is a L, right? We can see that this place is low because we know the fact that this place is higher compared to this place. This is lower. Just like you are climbing from your staircase, you are coming downward, right? Now, this, you can see that this second leg here is actually higher than this. It's actually, it's at a high, but it's lower than this high, right? It's lower than this high. So we'll call it a lower high. Are you getting it? We call it what? A lower high. Why this low here? This low here is a low, but it's lower than this low. Then we call it a lower low. Lower low. We call it lower low. So that is how we do it repetitively, like that. If I can continue to call this lower low, right? So lower high. I call this again lower highs, right? And I call this, and I'm going to call this one lower lows, right? Oh, sorry, permit my network. All right. So lower highs, still lower highs, lower highs, right? And we have lower lows. So what will be thinking that why this guy did not mark this other one, right? I'm coming. Don't worry, don't worry. So we have lower lows. If you wonder like, why did I mark this one and call it another lower low, a lower high? It's because at this point, the low, when we are dealing with market structures and marking of structure effectively, this is the lowest low that was created. Lower low. This is the lowest from here. This is the lower low. Sorry, lower low. So from here, this market actually created this low, right? But it never it created this high, which is a lower high indeed. But this one actually took it out, and this one that took it out did not get to this place. So in market structure, we used to call this. Let me just say it over time we will do it. We used to call normally we can call it initial change of character. Okay, some people call it initial change of character because they want to see that it's actually market is tending to change direction. At that point we call it change of character, but there is a but there. But in subsequently in advance we might it will not it when we are reading structure in advance, it is no more, it won't be called, even though it is still called change of character to an extent, but instead of calling it change of character we'll call it inducement. Some from people who are not in beginner class, now this is a tip for you. This is an inducement. Market just came to take out an induced liquidity at this point and then continue in its direction. Don't worry, you will get to know all those ones continuously. So it's an inducement. Market just induced price, take out, deceive some people, and then continue in its direction. So that is bullish, that is bearish. So at the same time, I don't want to see it repeated. So when I see the market now begin to change direction like this, market begin to break above this point and come down again. Okay, make market breaks like this, right? And come down again and fails to break this low, right? And now created this high again. At that point, I think the market has changed direction to the upside. It has changed, even if it does like this, I'll come and do like this. So I think the market has changed direction to its upside. Okay, to its upside. So that is market. That is bearish. Okay. Another thing we know we have is your entry point, right? Your entry point. At what point do you enter a market? We've talked about that. Those your buy limits, sell limits, instant executions, you don't just place them anyhow. These are what determines your market. Okay, these are what determines your entries in the market. You want to be sure that market is either bullish or bearish. If market is bullish, then you want to anticipate for a buy. And how do you buy? We said that market for we buy like this. Okay, we don't just buy because market is going up. If it's going up, I buy. No, you wait for what is called retracement. The retracement will be damage. It will be a mini sell. A mini sell. That means you will see some sell candle, market selling small. So a certain level, you will now see a green candle that want to like go up, right? And it's showing direction like this. I can see buy from here like this and target above this place. Okay, now once maybe I meet market coming down like this from here and it reach this point, and now market is now going a bit like this, and now say okay, since the structure from behind is showing me buy scenarios, right? Then I will decide to, sorry, I said decided. I will decide to now join and buy the trend from here and go up. So we'll see it in the chart, right? We'll see it in the chart. Okay, so that is a buy scenario setup. So that means I can buy from here with instant execution and target here above this high, But we want you to create a what? A higher high. And once you create the higher high, you leave the market. Don't say you want to stay the market to retrace and come again and go. For now, target just high to high. Okay. Subsequently, you can target higher. We can, except you are very good and to an extent we target. Of course, if market will keep going, we have what is called the all-time highs, all-time lows, and the likes. Don't worry, you will know where to leave the market as time goes on. So stop loss. So assume I've entered market at this point, right? Assume I enter market at this point. My stop loss will be below this low, or safer below this low. Okay, and my TP, I've told that my TP will be at the nearest high easily. 1:2, 1:3, 1:4, 1:5. You are out. Because there are times that market will do what's called fake out. Some people say, market just did me a fake out and then go quickly in my direction or something like that. No, initially I said that market can do something like this, right? It can do something like this and then continue like this. I think there's something like that on gold. Let me check yesterday market. Yesterday market, this weekend, so Friday market. I think on the 15 minutes time frame or 30 minutes or 5 minutes time frame. Let me check, or 1 hour time frame or so. Let me check something of 5 minutes time frame. If possible, I will see that setup. I think somebody sent me the chart for a sell, and I looked at it. I said, I let think better. This market, what it does there was an inducement to market is actually bullish on gold, not bearish. I've cleared up my chart because of this training. Let me see. Okay, so let's just see something like this. Look at this one. I think this is it. Yeah. So this is it. Yeah, this Friday. Okay, good. Now look at this market. Now the person actually took a sell. I think we had a sell from this point. Market was actually coming down. Now it was not looking well. We said that market did this and they decided to mark here as break of structure. Now, or change of character rather. But look at the initial trend of the market. Let's see what market was doing initially, because this is how you read the chart. If you come down to read charts, you will understand that marking of structure for those who are already in advanced classes or who have been trading before now. The market marking structure is very easy, very easy, very easy. So market goes like this, come like this, right? It's still creating. You can see now fails to create. Now you see again fails to break low. Now assume this one now break this low, we will have been considering maybe it want to start coming down. But now it also fails to break this low. What happened? It created a low here and did another. Let me just mark here as, even though it's not really a valid high, but okay, let's mark here as a valid high, and then created. You can see how it's creating low again. You see like it's failing to break up again, created low. Now somebody will mark here as, some people will mark here as market has changed direction. No, because this is not the lowest low that created this high. The lowest low that created this high was this low, not this. Even though some people will use this one, but the lowest low that created this major high is this low. So now market actually did this, and what again? Now this was where the issue is. Now the person saw that market break this high, right? Created this low, created this high, and broke here. So it took this as a change of character, which was wrong. This was an inducement, because market just came and tap out these people here and then decided to continue in its direction. And here again it formed a double top. Which shows that market can still come down again. Now again it fails to break this low. Assume it now broke this low, eventually we'll say that, oh, market is changing direction for a bearish direction. But no, instead it fails to break this low again, and did what? And breaks high, and now it has broken this high, and this was when it created this higher high. This was when it created this higher high. Now, after creating that higher high, you can see what market does. Created this low, go again. You can see now it's creating, even though these are lows that are not well, what is it called? West. Those are, sorry, let me drop it and drag down again. So you can see how it's creating its low, its highs, right? This would have been a straight line downward here, creating this, creating another high, and so I'm creating another high. Now taking out this low again. These lows, like I said, they are not really valid lows, so they are all these retracements, they are just inducement. Create this low again, coming down here and creating another high here. Okay, and that is how you see the gold reacting. So what are you still anticipating? Now against next mark, this is weekend, so market has closed. So you see market doing this and doing this. Now I'm saying so market now still if you still take out all of these lows, all these lows are inducement, just take them out, and if it will continue the uptrend, then to just after taking it out like this, it will now shoot up and take out this next high. So that is how bullish and bearish. So you will notice that there are times that markets will not create higher highs or higher lows like this. Market will just be doing what is called sideways movement. Okay, market will just be doing what's called sideways movement. Market will just be doing something like this. Okay, market will just be doing something like this, failing to move in a great direction, and that is what will lead us to what we call states of market. The states of market. So markets can only exist in three major states. Is that in the uptrend, the downtrend, or the sideways trend. And some people categorize it in two ways. They said it's called the trending market and the shopping market. So either terms you use, they are still saying the same thing. One, the fact that one market can either move in a uptrend, so it can go directly up like this. Sorry, 1 minute. So market can go straight like this, up, or market can come down, or market can go sideways. Those are the three states of the market. Anything outside that, the market does not do anything outside that. So it is now left for you to now identify those moments at which the market actually do that. So we know that the trending markets, right, is when price moves in one direction. Either it goes up or down. So for up, we say that you will see higher highs and higher lows. That's for uptrend. While for a downtrend, you will see lower highs and lower lows. So, and among those three conditions of the market, those two is the best to trade with. So the trend is your friend. There's always a popular stuff in trading, that the trend is always what? Your friend. Then the consolidating, which is also the ranging market, right, is when price is moving sideways. So it's not as if you cannot trade it. In advanced classes or in subsequent classes, you will see how you can trade the trend. The trend also is it's very risky for beginner, but advanced traders like us, some of us trade, knows how to map out our zones out from the consolidation. Some people actually trade breakout from what's it called, consolidation markets. Okay, so for now, avoid to trade breakouts. So it's best to avoid, or it's best to avoid consolidation market while you trade the breakout. The breakout has to do with when market actually leave that consolidation state, because as market is continuing like this, right, there are times the market will just do like this, boom, and give a clear direction. And the clear direction is just not one break. Let me just drop the sheet. It's either it does like this and retrace and continue and show you second break that is going that direction, or it can do what is called when we get to AMDs, accumulation, manipulation, and distribution, where market will just after a movement like this, let me just, sorry, 1 minute. Let me just withdraw it. Let me just withdraw it. After a movement like this, so after a movement like this, oh sorry, I think that I have my network issue here. What's happening? Okay. While I'm waiting for that, let me just explain that with the ones I've drawn down. So what happens is that after a movement like this, market can just come like this, right? Come like this, break this low, okay? That's what called manipulation, and then go up in this direction. This will be his main intention, and to just do something like this, and then go up like this. So you get, and then go up in that direction. So that is manipulations. That's sometimes market can, so market can break out with different ways. So you don't want to focus your mind for that this is how market does and this is how I'm going to do. No, you are not determining the market movement. Let the market say the stories they want to say, and why you follow part in what they are doing. Okay. So now, after understanding how that market is, that what is called, um, we've talked about trading sections, right? So I want to remind you, or let me just remind you, the four major sections. We have the Sydney, the Tokyo, the London, and the New York, right? And now there are characteristics to understand those seasons. For the Sydney session, right, we start from 10 p.m. to 7 a.m. At that point, one of the characteristics is that there's low volatility. Most of the people are sleeping, so market is not really volatile, right? Market is not active, no much trades going on around those periods of time. It does not mean that market will not move. There are markets moving, okay? The Tokyo session 12 a.m. to 9 a.m. The Asian peers are very, very active. The Asian peers, that's one of the assignments. Go and know what are Asian peers. Submit on the assignments on the group or the comment sections. The London session is between 8 a.m. to 5 p.m. So the Euro and GBP, they are very, very active. Any pair with Euro or GBP, they are very, very active and volatile. So I hope that's clear. Then the New York sections, 1 p.m. to 10 p.m. Any pair that is basic with USDs, they are very, very active. So now, for instance, now Euro USD, the best section is London plus New York because it has high volumes and liquidity. Okay, while GBP USD is just London session only because there's big move and strong volatility. Okay, while which other pair can I mention there again? USD is Tokyo and New York session. JPY is active in Asian and New York. The USD is active in New York session. Okay, I've already mentioned one one of the assignment answers for you, so you know what that means. If you are smart, you get it. All right, so AUD USD is another one you can use. This is in Sydney and the Tokyo session. Okay, so the US AUD is active, that's Australian dollar, is active in Asian sections, and then we have Euro JPY. Yes, Euro JPY is another one. Euro JPY is in Tokyo and London. Euro JPY is Tokyo and London, so both countries overlap. So we said that when currencies overlaps, what happens? There's volatility in the market. Okay, so you can trade pairs during their native sections for better movement and low spread. Okay, right. So that will take. Let's look at types of traders and their best trading plans. Every trader has different styles of trading, so you can decide which trader you want to be. Oh, and my network is back. Right rubbish on my screen. You can decide what trader you want to be. Okay, either you are a scalper, you are a day trader, you are a swing trader, or you are a position trader. Okay, most of us are day traders, but I will not decide which one you wish to be. You can pick your style of trading based on your person, because style of trading actually affect your, sometimes it determines the type of person you are. You need to study yourself. When we deal with psychology and the likes, you will understand better. But let's just list them out. We have the scalpers. The scalpers trades last minutes, like they focus between 5 pips to 15 pips trade profits. Okay, and their time frame is between the period of 1 minute and 5 minutes. And what do they do? They actually trade very fast. They don't want to waste much of time. They trade, best time for their trading is high volatile hours, like the London opens or New York overlaps. We talk that when market overlaps, there's always volatility in the market. So scalpers are always in that time frame. And if you want to be a scalper, you need speed, you need focus, and you need experience. A beginner cannot be a scalper. Forget it. Highest you can do is you are gambling. Even if you jump in, most of us will just jump in and jump out. Say, I've made $1, I've made $20 profit, and you jump in and jump out because you use high lot size and you quickly make $10 and you quickly make $100 with high lot size and you just jump in and jump out. That one is you are not scalping. You are not a scalper yet. You are gambling. That's not scalping. When you are a scalper, you are focused. You know the time you want to enter the market. You know what you are looking for in the market. You know what you want to see in the market that will make you to pick the trade. So you don't just say, I jump in and I jump out. You already win. No. Then what is called the day traders. Day traders opens and closes trade within the same day. So they can spend 30 minutes on a trade. They can spend 1 hour on a trade. They are still day traders. So their time frame is between the 15 minutes time frame. This is 15 minutes time frame. Okay, that means they analyze based on 15 minutes time frame to 1 hour time frame, or let me say from 5 minutes time frame to 1 hour time frame. They are day traders. Okay, the best time they trade London sessions maybe between 8 a.m. and 12 p.m. or they trade New York session between 1 p.m. to 4 p.m. So suitable for you if you don't have much time. Just set your time between 8 a.m. and 12 p.m. I want to trade the market. I come and see what I'm looking for within this place and I pick my trade and I leave for that day. Or between 1 p.m. and 4 p.m. you come and look at the market. Market has formed structure for you and you see it and you take trade within 1 p.m. and 4 p.m. You are out of the day for that day. Then we have what's called swing traders. Swing traders have to do with traders that hold trades for days. Okay, but the analysis is based on 4 hours to daily time frame chart. Though some of them use 1 hour to daily time frame charts. They are swing traders. Okay, so they trade high during high sections but manage less frequently. Okay, so they don't really just focus more on the noises on the lower time frame. So it's best for busy people. Okay, people who do 9 to 5 jobs, and they don't really have time, so they can analyze on higher time frame, pick a trade for that for Monday, and expect that by Thursday or Friday they just come and make profit and just smile to their bank account. And yeah, or just pick a trade from Wednesday and Friday they're out of the market, or pick a trade from Tuesday, by Thursday they're out of the market. And so those are day traders. Okay, then we have position traders. This one holds trades for weeks and months. Okay, some of them actually focuses on fundamentals and long-term structures, and the time frame they use is the weekly time frame, or month time frame. Okay, so sometimes it's best for investors, not beginners. Not beginners. I repeat, not beginners. For investors, those who have large amount of money and they just want to open a position and just leave it there and see what market does, like that. So take note of this. I said that scalpers, their time frame is between 1 minute and 5 minutes, and their best time to trade is between London open and New York overlaps. Okay, day traders, they are trading time between 5 minutes to 1 hour. The old time is in hours. Then they trade between 8 a.m. to 4 p.m. Okay, I break it down, either 8 a.m. to 12 p.m., then 1 p.m. to 4 p.m. So either way. Then swing traders, they trade from 4 hours to daily time frame, or 1 hour to daily time frame, depending on the psychology of the trader. Then they hold the period for weeks or days. Okay, then any session they trade. The position traders, their time frame is between the weekly and the monthly time frame, or daily to monthly time frame. So they hold the trade for weeks or months. So they are long term focused. They don't have time for any other things. All right, so we've come to the end of this class, and I hope you've learned something. I hope you are encouraged. I hope you are keeping the momentum high, and I hope you will continue. You won't give up. Tell yourself, I will not give up. I will know these things. Forex is simple. Forex is easy, and you are going to do something for us again. Subscribe, please subscribe. So subscribe. So your assignment is this: number one, you're going to tell me the difference between bullish and bearish. Not just tell me that. You're going to go to your charts, mark them out on your chart on any time frame. Okay, use 1 hour time frame. Okay, use 1 hour time frame to mark out structures of bullish, bearish, then consolidation or sideways movements of charts. Then number two, again, you are going to name for me 2 major currency pairs and their best session to trade them. Of course, I've mentioned so many of them here, but you can pick from it, or you can make research of yourself, and we will make corrections. Okay, then you're going to make a decision. Are you a scalper, day trader, swing trader, or position trader? You ask yourself that one. Like I've told you, you don't want to be one of them for now, since I begin now. All right, so what time do you think is best for you to trade based on your own daily routine? Everybody have different schedules. Forex is not a do or die. It's not what you're going to do every minute to sit on your chart. Of course, there are people that take it as lifetime business, okay, that you can stay with it all through the day, but at the same time you still get occupied with different other things. But as while you are learning Forex, you also want to keep yourself busy with other side hustles to get money from other way. Of course, you can also get money from your business to fund your Forex account. Okay, so what time do you think is best for you to trade based on your daily routine? So drop your answers in the comment section or in the group chat. I want to love and see your reactions also. I believe this class has helped us clear some confusion. Don't forget to like, subscribe, share with friends, share with someone learning Forex. Now, next class, I think we've come to the week one begin introduction basics. Okay, it's going to be exciting from next week. And don't forget that tomorrow is going to be live class. It's going to be live class. We're going to be live class on our channel. We're going to be taking the live class. We'll take your questions, your comments, your reactions, market reviews, and the likes. So our next week is going to be bombing. It's going to be bombing. Say bombing, because you are going to be getting into the anatomy of charts. Oh my God, you cannot wait to watch out for it. Okay, you're going to learn how to read all of this, something they call candlesticks, all of this movement. You're going to learn how to read them. You're going to understand why we draw what's called trend line and where to draw them. You're going to understand zones. You're going to understand price structures, and some other things. Next week is going to be exciting, really good, exciting, and build your confidence in just not just picking trade randomly. You are going to pick a trade with precisions from next week. Okay, all right. So until then, keep learning and practicing. I'm Joseph Samuel, and this is SAFOREX Academy, where we help you become a confident and a consistent trader. Okay, God bless you, and see you in the next class. Peace out.